Hi, it's Patricia here from Your Vision Financial. The federal budget was announced last night, and there's some very significant changes that could impact investors, particularly around capital gains tax, negative gearing, and discretionary trusts. So today I want to take you through what these means and what to start thinking about. Firstly, these are just proposals. They're not law yet, so they still need to be passed. But if they do go through, this is one of the biggest shifts in investor taxation that we've seen in quite some time, especially from July 2027 onwards. All right, so let's start with the big one, CGT changes. Capital gains tax changes are coming through if this goes through, where if you hold an asset for more than 12 months, you currently get a 50% tax discount. That's going to be changed and removed so that instead you will get an inflation indexation using CPI, and there's a minimum 30% tax. So what does that actually mean? Well, if inflation is low, you're likely to pay more tax than you do now. If inflation is higher, then indexation helps. But for most people, this won't really replace the benefit of the 50% discount. And importantly, there is a floor now of 30%. So you'll at least pay 30% tax. Now, the transitional rules are really important. If you sell before 1st July 2027, the current rules still apply. If you buy and sell after that date, then the new rules apply fully. If you already own an asset and you sell after 2027, there'll be a split treatment. So you get to keep the 50% discount gains until 1st July 2027, but then the indexation applies from then onwards. So in practical terms, you're going to need a valuation of your assets as of 1st of July 2027. There's some exceptions for newly built properties that will still be able to be to use the 50% capital gains tax discount. Now let's talk about negative gearing. So negative gearing will now only be restricted to newly built properties. So after that date, any losses can only offset rental income, and you can no longer offset those losses against your other income like your salary. Now, if you already own property, then you're generally grandfathered. But if you buy before 30 June 2027, you can still negatively gear until then, but you can't negatively gear after 1st July 2027, unless it qualifies as a new build. What counts as a new build? New construction on vacant land or developments that increase housing supply. So renovations and knockdown don't qualify. Now, what's important to note is that none of these changes apply to your superannuation fund. The third big change is tax around discretionary trusts. So that's a bit of a tricky one. So now there will be a minimum 30% tax, a 30% tax that will apply to discretionary trusts, and they receive a non-refundable tax credit. So what this means is the flexibility of distributing to lower tax individuals is significantly reduced. So we're going to have to reassess whether those structures are still appropriate for you if you have a discretionary trust. Now, there will be a 3-year rollover relief benefit, which will allow people to restructure out of discretionary trusts if needed. Now, a quick note on super. There were no major changes announced, so super continues to remain the most tax-effective environment, particularly in comparison to these proposed changes. So what should you do now? Well, right now, it's about not making any quick decisions. These are the things that you need to be aware of, and we just need to make sure that we prepare. The changes may not pass as they are announced. There may still be changes coming through. But if you're an investor, a business owner, or a trustee of a discretionary trust, it's probably a good idea to review your strategy before 1st of July 2027.